In this video, we are going to talk about why did Netflix crash so badly. So before starting, please like this video and subscribe to this channel for our future updates. Netflix's stock, NFLX minus 1.24%, was on fire on Wednesday, dropping as much as 39% in morning trading. The stock was still down 36.7% at 11:50 a.m. Eastern Time. We aren't here to chastise Netflix. The news this morning, on the other hand, necessitated kicking Netflix a little while it was down, and while its stock was considerably down. The stock of Netflix, NFLX, finished at $348.42 per share on Tuesday. Netflix was down more than $100 per share when the markets reopened at 9:30 a.m. Eastern Time on Wednesday, its lowest level since early 2018. Following that, it plunged another $25. It closed at $226.19 on Wednesday. Shares briefly traded at $700 each last October. What the hell is going on here? To begin, it's worth noting that the majority of the Tuesday to Wednesday loss occurred all at once, shortly after the U.S. financial markets closed on Tuesday, when Netflix disclosed it had lost 200,000 global paid members in the first quarter of 2022. Although losing subscribers is never a good look, and it's the first time that's occurred to Netflix in the last 10 years, the firm had anticipated adding 2.5 million subscribers during that time. Netflix also revealed that it will lose an extra 2 million paid members in the current quarter. The streamer blamed four things in a letter to shareholders. The first may be summarized as well: we can't control everything, which, like the other causes mentioned by Netflix, is not new information. It's becoming increasingly clear that the pace of growth into our underlying addressable market, broadband homes, is partly dependent on factors we don't directly control, such as the uptake of connected TVs, since the majority of our viewing is done on TVs, the adoption of on-demand entertainment, and data costs, according to the company. The second option is to share accounts. Netflix had around 222 million paying homes at the end of the first quarter, and it believes that those customers share their accounts with another 100 million households. Overall, the company estimates that over 30 million households in the United States and Canada, also known as UCAN, are not being monetized, yet widespread sharing has always been the case. In a Wednesday analysis, media analysts at MoffettNathanson stated, "We find it interesting that Netflix never revealed the UCAN data point sooner." When questioned if UCAN was mature in the past, the firm would typically point to the 100 million peak US TV homes as their ultimate US TAM, total addressable market, and indicate they still had a long way to go. They may have been at that 100 million TAM all along because they had nowhere further to go. Netflix also mentioned growing competition from Peacock, HBO Max, Apple TV Plus, Discovery Plus, and Paramount Plus, which affects all streamers. MoffettNathanson isn't convinced by the excuse once more. The acknowledgement that competition has intensified in the US streaming video business and may be affecting growth was also quite evident, the analysts noted. How easy would that be in a world where everyone wants to increase their market share by spending more on content? Courtesy of Netflix. Finally, the business cited prolonged COVID outages, Russia's invasion of Ukraine, and rising inflation as reasons for the decline. True, the suspension of service in Russia resulted in the loss of 700,000 submarines in the first quarter. With only 500,000 new subscribers in the same time period, Netflix was left with a 200,000 subscriber deficit. Normal operations in Russia would assist, but Netflix would still fall short of its target of 2 million members. Our aim is to re-accelerate our viewing and revenue growth by continuing to improve all elements of Netflix, in particular the quality of our programming and recommendations, which is what our members love most, Netflix wrote to shareholders in an attempt to get out of this bind. Those answers, like the difficulties Netflix is facing, aren't brand new. However, the corporation is already cracking down on password sharing through a trial run in 3 Latin American markets that gives users the option of paying a subsidized charge for extra households or losing access. More effective monetization of multi-household sharing, as Netflix put it, is obviously here to stay and will grow. The company's matter-of-fact admission in the interview, and not in the press statement was strange and virtually a throwaway phrase aimed to draw attention, MoffettNathanson observed. In terms of gaining attention, the mission was successful, but it did little to save the market cap in the short run. Netflix stock's neutral rating was maintained by MoffettNathanson, but its target price was slashed by $105 to $245 a share. Because the stock finished at such a cheap price, the valuation objective might make it a buy, our words, not theirs. With the crackdown on account sharing and the addition of an ad-supported option, Netflix may be able to right the ship that has suddenly gone awry. Not only will an ad-supported tier provide a new revenue stream for the corporation, but it will also help it monetize viewers in less developed countries. There are plenty of potential Netflix members in India and Africa, but they aren't willing to pay $15 to $20 a month. They've also shown a willingness to endure through ads in order to get streaming material. The realities were not addressed by Hastings or the shareholder letter. How would the company offer an ad tier without cannibalizing their subscription revenues? MoffettNathanson wondered. What will they sell and how will they sell it? What are the costs of putting this project together? All of these are excellent questions. But do you have anything more interesting to say to bring this story to a close? In an instant, we've seen a firm fall from growth darling to growth purgatory, they wrote. And although we thought we were kicking Netflix while they were down, the real kicker is the media experts. The announcement that its subscriber numbers actually decreased last quarter, the first time in more than a decade, was the impetus that pushed the streaming pioneer lower. Netflix made $7.9 billion in sales in the first quarter, increasing 9.8% year-over-year, but its profits per share, EPS, fell 5.9% to $3.53. To put those figures in context, experts had predicted revenue of $7.9 billion and earnings per share of $2.90. The big news was that Netflix lost about 200,000 customers in the first quarter and expects to lose another 2 million in the second. Inflation, the war in Ukraine, which has hindered adoption of the service in Eastern Europe, rising competition, and password sharing are all factors listed by Netflix as contributing to the loss of subscribers. The news isn't good, but it's also not as bad as it may look at first glance. Management detailed the suspension of its operations in Russia in the fine print of its investor letter, which played a key part in the quarter's subscriber loss, italics mine. Paid net additions decreased by -0.7 million as a result of the suspension of our service in Russia and the winding down of all Russian paid memberships. Removing this impact, paid net additions increased by +0.5 million. Netflix's management has acknowledged the company's continued issues and is looking into a variety of options to reignite membership growth. The company's primary focus will be on improving the quality of its programming and recommendations, but it will also look into measures to combat password sharing and continue its international expansion. Investors are right to ask if Netflix's growth narrative is coming to an end, given its sharp slowdown in subscriber growth. In 2022 and beyond, management intends to return to and sustain double-digit percentage sales growth while remaining free cash flow positive. Personally, I don't believe the sky is falling. Because this isn't a fade to black situation for Netflix, the sell-off may represent an attractive opportunity for investors. You'll want to hear this before you consider Netflix Incorporated. Netflix Incorporated was not among the 10 best stocks for investors to purchase right now, according to our award-winning expert team. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.